Hey everyone, this is Brant at Wolf on Wall Street Trade and thetechnicaltake.net with a follow-up to last weekend's video, which was the Fed's panic rate cut, which has opened up the door for a lot of other central banks to start cutting rates and easing policy pretty aggressively, which is what we saw from China, the People's Bank of China, PBOC, this week. That's kind of the big story. But just about everything that I talked about in my subscribers post the day after the Fed, which was called Reflation in Q4, so far has come to pass. I touched on a lot of those things in last weekend's video, which includes slowing growth in the US. And we also got a peek of that too in the Euro area. Here is the composite PMIs. And for the US, we got some additional data this week. U.S. manufacturing PMIs, and you can see they continue to come down. Under this 50 level is contraction, above it is expansion, so we can see growth slowing as well in manufacturing in the U.S. And the Richmond Fed's Manufacturing Index, which has seen its steepest decline since May of 2020 COVID lockdown, so that's not looking great for growth. And as far as the inflation component, that is the scary thing to come, and that is the chance that the Fed took with such a large rate cut right off the bat. And this is a quick highlight from that subscriber post the day after the Fed, and I was talking about different assets that I thought would do well in Q4, maybe into 2025. And I said about China, if China announces stimulus, then China would be on my radar as well, because I had just highlighted several emerging markets that I liked, but I want to stay away from China because China's in a real mess if you looked at their stock market before this week. Stay away from China and EEM unless China stimulated. That's exactly what China did this week. So the PBOC came in and they stimulated on the monetary front, and the government came through, or actually didn't come through yet, but they vowed a lot on the fiscal front. So we saw Chinese markets absolutely soar this week. Just take a look at the second sentence in this post as well. While U.S. markets are green lighted to inflate with the Fed's 50 basis point cut, they might not be for long when inflation re-accelerates, which is a good probability in Q4, which is rapidly approaching. While U.S. equity investors were all bowled up after the Fed's rate cut, the S&P did 0.6%, while FXI China 25 did 5%. And if we look at that in terms of the percent gain, and we do that on a weekly basis, what you'll see is this is the best week for FXI ever. And then if we take a look at the Chinese Internet ETF, KWEB, it gets even crazier, almost 27% on the week. I mean, that's insane. Take a closer look at that candle. It's just absolutely huge. EEM on the week, Emerging Markets ETF, up 6.7%. And I'm not going to go through all the other emerging markets because there's a couple that are picks that we have for subscribers, and they are not really East Asia, but like Africa and some different areas. I'm going to add another one this week. As far as the U.S. averages, here is the S&P 500 on a 10-minute chart. This area right here is the FOMC, so we got that little gap up the next day. Options expiration over here, real big one. We've been trading in this kind of ascending triangle, right? That came to an apex by Friday. And generally what happens is if it's a strong bullish consolidation, which these are bullish consolidations, they will break out about 2/3 of the way to the apex. So it actually started to break out on Thursday, kind of didn't really get too far. If we look at the NASDAQ 100, it's basically the same story. We actually got a pretty strong open on Thursday morning. Price came down. This 20K level has been kind of a little bit problematic for the NASDAQ 100, but what it did do was fill in this gap from back here on, what is that, July 16th, 17th. If you're a subscriber, you know right around here, July 15th or so, kind of the mega caps and the AI trade lost their leadership. The market came down, came back up. It hasn't really regained that leadership since, but we did basically fill in that gap What is going to be interesting is what happens from here next week. So this technically isn't a failed breakout. It is an attempted breakout. It hasn't really gained a lot of momentum, but that's kind of like the theme of this week has been kind of very low conviction trade on both sides of the tape. And that's basically what 3C has been showing us too. So if we take a quick look at that, here is the low and kind of like a little consolidation, a kind of basically just a test of this low that passed. So successful test. 3C a little positively divergent there, running up. Here's the Fed, the FOMC. Here's that consolidation this week. And we could see 3C's acting. It's not like really in a bad negative divergence considering the time frame. It's in the kind of divergence that you would see, at least up until this point, heading into a consolidation. So for prices to have sort of broken out of that consolidation, we should see 3C heading higher before that actually happens. And instead, we're kind of seeing it head lower, and it's the same thing pretty much for QQQ. You can see actually almost exactly the same on 3C's chart. So there's the test, a little bit more successful test in QQQ's case, and up here into this consolidation, just not getting that toe hold in 3C on this attempted breakout Thursday. Perhaps one of the reasons is that money is flowing from Western countries to Eastern countries. I mean, look at the volume on FXI, or if we look at KWeb, just spectacular volume, and that is what you should see on a healthy breakout. And that is what we haven't been seeing in U.S. markets as of late. As far as the other half of the lower growth, higher inflation forecast or hypothesis I have for Q4, what would cause inflation to go up? Well, if you think about it, China stimulating and trying to kickstart their economy or jumpstart it back to life would be a top reason on my top 5 list of reasons. If we look at the 10-year yield real quick, one of the interesting things was, here's the FOMC. That night in after hours, we saw yields moving higher. And ever since then, we've seen yields moving higher, not significantly higher, but higher. One of the assets I highlighted for my subscribers right after the FOMC, the morning after, and I talked about in last weekend's video, is copper. So that is, in my opinion, Dr. Copper. It has a PhD in inflation, deflation. I was talking about it last week, just starting to break out. And let's take a look at copper futures. And what we were looking at last week was copper was just starting to move above this kind of resistance area of 431. We have a higher low over here, so it was just starting to make a higher high. So this week we could see a really nice move in copper, more than 5%. And if we look at the volume, probably best to look at it on a daily chart. And look at these two nice big price candles. And that is all on China stimulus. And look at the volume. I mean, it's rising, big green bars in volume. That is just something we're not seeing in U.S. stock indices. If we look at QQQ, you can see this small pullback over here, volume rising. We get a nice rally over here. Volume does not even cross above this 200 bar average of volume, but as soon as price comes down, what happens? Volume start rising again. So the volume we're seeing with the price action in copper is very bullish. The volume that we're seeing with the price action in QQQ or the SPY or anything like that, not so much. If we look at yields, the 10-year yield again with copper overlaid in blue here, we can see that copper is going to be putting some inflationary pressure on yields, which is, the whole point of that post the day after the Fed and last weekend's video about slower growth in the U.S. in Q4 and higher inflation. So if we look at copper again, it's going to be putting some upward pressure on inflation. The thing that's holding it down a little bit right now is going to be oil prices. And here the blue line is crude oil. So crude oil has had this nasty zone of resistance at 72. It almost seems like somebody's got their finger on the scale a little bit, or thumb on the scale. And here is WTI crude with this 72 area right up here. So it's come up to it a couple times and we've seen heavier volume just kind of rejecting it. And it looks like price resistance, but the way all the inventory data for crude oil is coming in and the geopolitical risk in the Middle East is just not being priced in at all. It really seems like there's something else going on. So we got up here towards 72 and a really heavy rejection, like a lot of volume on that. Could it be related to the U.S. presidential elections and wanting to keep gas prices down before then? It could be. That's kind of like my skeptical view of things. But if WTI crude oil does break above the 72 level with some moxie, I think you're really going to see the CTAs and hedge funds that are shorter oil now than they've ever been in history just trigger a nasty short squeeze and send oil higher, which is going to send inflation higher, and that's going to show up in the inflation data, and that's going to create the nightmare scenario for the Fed. They took a chance cutting with 50 basis points instead of 25. The chance is that they reignite inflation. So we'll see what oil does. There's been like a lot of just funny business with oil. Like this week we had a Financial Times report, unsourced, that Saudi Arabia was going to abandon its $100 target level on oil. But it's unsourced, right? So we saw the exact same thing like almost a month ago, except from Reuters. So 1 week they had that OPEC Plus was going to adjust production, that they were going to raise it, and oil prices fell, and then a week later they came out and said, oh, no, it's not going to happen. So whenever you get these unsourced kind of media reports right at crucial levels like the 72, I view them very skeptically. Silver has been acting a lot better relative to gold. It is starting to catch up, and silver has a lot more uses in industry than gold does. So again, this is another inflationary type move that we've been seeing since the Fed cut. And all that has been happening with a relatively stable dollar index. I mean, I do think the dollar index is going to break down lower. That was kind of the whole point with last weekend's video about the Fed cutting rates, the dollar going lower, things that are priced in dollars go higher. And we do see like this kind of a bearish, let me see if I can draw it in, but it's a bearish descending triangle. So you could probably see it, but it's a little something like this. So a bearish descending triangle, prices starting to break down. This breaks down, means lower dollar, higher prices for things that are priced in dollars, more inflationary. Semiconductors were an area that did pretty well this week. They are coming up to like a little zone of overhead supply, and that's right over here in this area, kind of where we got this hanging man candle. So this is where tech and semis lost their leadership. They haven't regained it since. And if we go back to that prior chart, this is kind of looking a little bit like a big head and shoulders top of sorts. So let's back out, and you can see it here. Kind of a left shoulder, kind of a head, a neckline here, and working on a right shoulder. And the 3C chart really doesn't dissuade me from that view. If we look at SMH for the semiconductors, this was actually, when it was happening, it was more pronounced than it is now, just because of the scaling. But this is where that leadership broke down. So we still do have an open gap there. That's what NASDAQ filled this week, but semis haven't yet. 3C is looking toppy here to me. So every time we kind of got any kind of strength over here, it was sold into. And over here, 3C is just not confirming this rally. Again, it's not the kind of signal that suggests like there's like heavy ongoing distribution right now. It just suggests that there's really light conviction as compared to what we saw earlier in the year or lots of 2023. For instance, here on this much longer time frame, I don't usually pull these out because we don't usually get divergences on them that often, but this is semis, this SMH ETF, and 3C's confirming up here. This is what confirmation looks like. It's positively diverging over here in October, which is when we basically got the short squeeze driven rally, the end of October into November, December. But in this area where they're starting to look a little toppy, you can see 3C's not confirming on these long-term time frames either. And here's the king of semis, probably the king of the market, NVIDIA, with the trend line. Interesting trend line because it has been acting as resistance in these areas and resistance this week in particular. But in addition to these lower highs, we also have a higher low over here. So it's still in a place where the jury's kind of out, but this is a really interesting trend line. So keep an eye on like this 125 level, 127 maybe for NVIDIA. Just a little bit more house cleaning. If we look at the S&P 500 this week and VIX, and then I'm just going to invert VIX. There's a little bit of relative strength here in VIX on Friday. You can see, let me just invert VIX and it'll be a little bit clearer. So you can see a little bit of relative strength kind of leading the S&P lower. I'm not sure what to make of that yet. I always say like one day is not a trend, but if we see some more of that next week, especially in light of the really elevated historically high skew index, it's something worth keeping an eye on. One other thing worth keeping an eye on that also falls into the category of one day is not a trend is the dollar yen, which is over here in the candlesticks, the red and green. I have S&P futures here, so a big plunge. That's on a Japanese election, hawkish PM, I believe. So I'm not sure if this is going to break down and kind of kickstart that same carry trade unwind that we saw in, what was it, July? Yeah, I backed this chart up just to double check it was July. So that was the beginning of it. So this is the carry trade unwind. This was what was really nasty about that sell-off in July into August 5th down here. And the S&P's rallied quite a bit away from the dollar-yen pair. If I go out a little bit longer here, you can see it. But there's the decline. So we just want to watch this move. So if we get, a break of like that basically 39 level on the dollar-yen, that could restart a carry trade unwind. Nobody really knows how much of that carry trade is left to unwind, but it's certainly a potential risk, something worth keeping an eye out on. And like I said, one day is not a trend, but it's on the radar. From here, I think one of the biggest things to be watching is WTI crude or crude oil in general. But for WTI, like above the 72 level, which will basically start a short squeeze, and that will create a feedback loop upon itself and just drive prices higher. That will be very inflationary. That's probably one of the number one inflationary dynamics as far as commodities go. But copper's already showing that, as we saw this week. And this is the gist of what I was saying in last weekend's video and what I've been posting for subscribers since the Fed cut those 50 basis points is look out for a slowdown in growth. We will get payrolls next week. That'll be big, but look for a slowdown in growth, a pickup in inflation. That changes the kinds of things you want to invest in. So like defensive sectors have been doing really well, but one of those defensive sectors like consumer staples won't do so well in that environment. So utilities would be what I would continue to lean toward, but obviously higher inflation, higher input costs are going to squeeze margins for those companies. I'll be watching 3C because I think we're seeing more, or we're going to see more of a flow of funds from the West to the East to China. Investors may really try to push the Chinese government. They may knock stock prices down after this week's run just to push the Chinese government into making good on their vow to stimulate fiscally. But there are quite a few emerging markets that look way better than the U.S. One African country emerging market that I threw out there for subscribers did 6.5% this week, whereas the S&P did 0.6%. And then the bigger theme really with what the PBOC did this week is Beijing is just preparing to export inflation, and they're going to export it right to the West, to the United States. So I think that Q4 theme that I was talking about last week in the video and that I've been talking about almost every day for subscribers is going to be a big one in Q4, potentially heading into 2025 rather. And that may make the Fed regret going 50 basis points on that first rate cut. Another thing to keep an eye on, October 1st, we could have all U.S. ports on the East Coast from Maine to Texas shut down because the longshoremen are set to strike on October 1st. So that is something that would have a massive inflationary effect as well as the supply chain would break down. So this was just a quick follow-up to last weekend's video. If you're not a subscriber, I do this real time every day that the market is open, 4, 5, 6 posts a day sometimes in real time. So check that out at wolfonwallstreettrade.com, and we are moving to thetechnicaltake.net soon. Have a great weekend, everyone.